such company which has made a grand comeback, I think, is PB Fintech. Yashish and we've been interacting on this channel, on this various forum, and I distinctly remember the last time when we met was class of 21, and it was such a show which set the tone for all of us in terms of understanding of where the business models are moving. So Mr. Dahiya, good morning. Thank you for joining us. When we spoke to you last, at least that's the conversation you and me had, your guidance was 1,000 crore of PAT by FY27. But between that and now, the world has changed. Business has become better. Competition has got diluted, and interest from stock market has made a roaring comeback. So can I say that it is time for you now to revisit your guidance and perhaps make FY27 as 26? It's a reasonable question.
First of all, thank you very much for having me here, Nikunj. It's always a pleasure speaking with you. My guidance has not changed. It had not changed then. It has not changed now. If you had asked me on the day of IPO, it was the same guidance. And even today, it's the same guidance. And I don't think anything has changed at our company. Yes, we might have, this year we might be performing a little better than expected. But I think that's not anything significant, right? It's just maybe 5-10% better than expected. So I think our guidance stays the same. Just to give your viewers, because everybody would not be as clued on as you are on this. See, this year we will broadly be PAT positive, and every year in our core business we add about 200 crores of incremental profit, and this comes from both PolicyBazaar and PaisaBazaar together. And so over 3 years, between 24 to 27, you would add about 600 crores of positivity. And there's some positive upside here possible because in the later years, the renewals become a very large chunk. The second part is we, even this year, will be spending about 170 crores on new initiatives as a loss. And we expect by 27 to make that zero. So you should see a delta of about 760 crores from this. And the last part is, while this year, our EBITDA and or adjusted EBITDA and our PAT numbers are going to be very similar, by the year 27, our PAT will actually be 250 crores more than our adjusted EBITDA. Simply because the differential between interest income and ESOP charges. See, our ESOP charges this year are 350 crores. Last year was 650 crores. But by the 27 year, they will be less than 100 crores. So you see a 250 crore delta right there. Plus our cash reserves are growing. Even this year, we are adding about 400 crores of cash. We have the same amount of cash as we had on the day of the IPO. So I think, Nikunj, nothing has changed. It is just, what we said, just turning out to be real. That's all.
What has changed from a market curiosity standpoint is the birth of geo services and the fact that they're looking at scaling it up. They're looking at a lot of tie-ups, at least on the distribution side. And they've started with BlackRock. We understand that they could be changing the way the insurance distribution is done. Is that a welcome competition or something which you need to be cognizant of?
I think everything is a welcome competition. Please appreciate what we do is very specific. We cater the 86% of the value, the way I calculate the value, which is NPV of the company, comes from 2 single products, which are basically protection, health insurance, term insurance, right? So for us, those are extremely critical. And those products, whoever has to do them, whether it is X, Y, Z, has to do it with a lot of passion and a lot of effort. And it will not happen easily because customers don't stand in a queue to buy these products. Usually what you need is a lot of convincing people and a lot of hand-holding during the claims process, because these are mostly painful products. In both of them, you pay money to never see that money again and hope you never interact with the product ever, because either you would have to die or be in a hospital to interact with that product. It's not a happy experience. It's a very sad experience. Not many brands would like to get involved in that. And it's not a very profitable business at the end of it. Please, let's appreciate a very simple thing. I think people get carried away. When you sell a term insurance, a 1 crore term insurance, 15,000 rupees, you make about 4,500 rupees, right? As a distributor, as whatever, whether it's marketing, whatever. When you sell a 3 lakh rupee loan, you make 9,000 rupees. Now, which is easier, selling a 1 crore rupee term insurance or selling a 3 lakh rupee loan? When you sell a credit card, you make 2,500 rupees. I'm just trying to explain to you. People think insurance is very profitable. It is not necessarily so. You can do much, much better in lending. Unless you have the deep passion to solve for the middle class, for the health insurance and life insurance, this is not a business worth going. It's not a business which is going to take anybody to Mars or whatever.
Fair point taken. Yashish, the other thing is, everyone in the market is now talking about Bima Sugam and as to how this could really be a UPI moment for the insurance sector. How would life change for you?
See, we get put on a very uncomfortable spot here, and I'll explain why. See, it's a regulator-sponsored project, right? And we are a regulated entity. For us to have anything but a positive comment on it is sort of suicide. So I think very difficult, but I think I'll still take a stab at it. See, UPI was a great platform which enabled payments across banks, across people, and that's helped a lot. But at the end of it, it still took a Paytm, a PhonePe, and a Google Pay to make UPI very popular. And I think in the same breath, what I would say or suggest is that as long as the platform stayed a service platform, solving for claims, see, what are the biggest issues our customers face today? Claims not getting settled or pain in customer servicing. If that part is what is focused on, it would be fantastic. If sales is focused on, I think we already have 3 million agents and banks and insurance companies and people like us trying to sell. It is perfectly fine, but I don't know how efficient an effort it is to get into sales. I think any form of differential licensing would be a very serious issue. Differential licensing means I can do X, but others cannot do it. Then that then just means then might as well not give others a license, I would say, right? But I think I've said more than I should usually say, because I do recognize that we are a regulated entity, and it's a very difficult position to be in. And I think people should be fairly cognizant and respectful of our position as a regulated entity.
There is one clarity which perhaps everybody wants to understand, that when will the entire ESOP charge finish completely, and in their whole talent hiring sequence, what kind of future ESOP policy are you likely to follow?
So we have already indicated that. In fact, yesterday or day before, we had our board meeting. And what we have done is we have moved our future ESOPs, all our future ESOPs, to market-linked ESOPs rather than discounted price ESOPs. So that tells you how we think about the future. We will not have ESOPs which are given out at 2 rupees or 10 rupees or whatever. They will actually be at market price, and management will be rewarded for taking the price upwards from then onwards. What happened in the past and what was rewarded in the past is a thing of the past and will over time keep coming down. I think we started off with roughly 600, 700 crores per year cost. It will settle down at about 100 to 150 crores. It will come down to about 100 crores to begin with, and then I think our management cost from a ongoing basis should be about 100 to 150 crores a year.
Mr. Dahiya, I always wanted to, perhaps understand from you that this entire, in retail, we call something as omni-channel, which is that you have online and offline presence. In insurance, what is a good model? I mean, will it be digital service by a physical model, or your distribution model will be where you need on-feed agents which are serviced by in physical infrastructure?
I think, in insurance, there are a lot of struggle points. The struggle points are at the point of claims and at the point of customer servicing. When the person buys a policy, how quickly can he cancel it? How quickly can he get his refunds? When the policy ends, how quickly does he get the money? How effortlessly does he get the money? How easily is the claim process managed? You're hearing a lot of noise around the claims experience consumers, right? Now, those things impact the confidence of consumers. And thus the consumer says, okay, who do I trust in this whole situation? And I think for that, to some extent, physical presence becomes helpful, which is why we have deployed it in more than 150 cities now. So I think it's an interesting place, but I think the problem we really need to solve is that. One more thing I would mention to you. In the last 15 years, whenever we have had a chance with every insurance company, and every insurance company knows this, when they have two products, one is a zero commission product and one is a commissionable product, we have always preferred the zero commission product, always. And that is without exception. Because please appreciate, in insurance, you don't make money just for commission. There is marketing, there is outsourcing. There are many ways in which you make money. There is consulting services. There are many ways in which you make money. Commission is just one of those ways. And even zero commission products have charges, whether it is a marketing cost, whether it is a call center cost. So all I'm saying is insurance has not reached a stage where people are lining up to buy it and just need an app where they can interact with it. And thus, the physical support and the physical push is still required. And whether it is through a contact center, a video call, or whichever mechanism. And it's not just to sell, it is also to impart confidence that at the point of claim, that increasingly I'm hearing that when you buy from PolicyBazaar, I hear it from the consumers increasingly, that when you buy it from PolicyBazaar, more often than not, you are likely to have a better claims experience because they are getting involved in the claims experience and they are there at the point of claim. So I think that is what is required. Yeah, at the end of it, automation will become a reality, but before automation happens, the operational support is required.
Hygiene question, you've denied it though, but I want to understand this again. The buzz of PB Fintech moving into the manufacturing space. You've gone to the exchanges, you've said, no, we're not doing that. So will it remain like a no, that you will not move into manufacturing at all?
I think manufacturing needs to be defined very clearly for us to answer that question very clearly. And Nikunj, with you, I don't have any difficulty answering any question whatsoever. We're not shy of answering anything, right? Unless it's misunderstood by people. We are crystal clear. We do not want to become an insurance company. Which means we have 50, 60 insurance companies in the market. Most of them are our partners. We do not want to become a competitor to them. That is not our intention, not today, not ever, right? What we do want to do is enable them. Enable as many of our partners, whichever way we can, as a distributor, as a product data provider, as a product initiator. We have a lot of product ideas. We want to help in that. And we believe some of our partners face difficulty in terms of reinsurance pricing. And thus we want to also assist them on the reinsurance pricing side, because we do have enough data which implies that we believe that we can deserve better pricing than exists in the market today. And for that, we would like to become, let's say, a reinsurance broker. Now, that is actually the end of it. Because what we eventually want to be is a reinsurance broker. Now, for that, you may for a while have to be a reinsurance carrier. Now, that is not a board decided thing, but I'm just speaking, plainly. At this point, we've not even gone to the board. And we, may have to show a bit of capital in that. However, our intention is not to become a reinsurer and become a very capital intensive business where we invest a lot of capital and, that's not our intent. Our intent is to be an enabler, be the data provider, be the tech provider, be the process provider, be the process definer, be all of those things, but not be a competitor, but be a supporter to all our partners and allow better and better products and better underwriting to happen in the market. I think the intent is crystal clear, to be a broker, whether as the broker is just a word, right? It's an enabler, whether it's at a distribution end, whether it's at a reinsurance end, but essentially be an enabler. And if for that enablement, if we have to deploy some capital, we are very happy to do so. We have capital at the end of it. But the idea is not to become a capital intensive business.
Such a pleasure having you on the show, and we must say that Nikunj and I were just discussing that you're one of the most candid speakers we have.
Thank you so much. I
Thank
really
you.
appreciate being here with you. Thank you.
Okay, great. That's the word coming in from PB Fintech right now. Let's just bring up what the stock price is up